Hello and welcome to Crypto Weeklies. In this video, we discuss when to buy Solana, when to accumulate Solana. None of the content is financial advice. Let's get started with our latest inclusion of composite risk analysis for Sol. This is the homepage of my website, cryptoweeklies.com. Link is on the bottom of the screen. All of the content available for free, personally developed by me. So this composite risk analysis for Sol between 0 and 1 points that Sol is right now in accumulation phase. That does not mean that Sol cannot go down in 2026. It's just historically speaking, based on the analysis of historical price action, uh, the uh, the the composite risk is now lower than zero point 0.3. It's at around 0.286. For context, even Bitcoin and ETH and major cryptos such as XRP are also in that zone. Sol is slightly elevated. Risk for accumulating Sol is slightly elevated than these risk for other cryptos. The way this is calculated is it's a composite analysis of various risk-based indications, the regression-based analysis that we conduct on the channel. Also the time weighted average price analysis, 20-week simple moving average analysis, percent drawdown from the previous all-time high, volatility in terms of standard deviation of returns, beta correlation with S&P 500, Sharpe ratio, risk adjusted returns, and inverting that to get to a composite risk score, which again, if you want to read, you can go to the full report over here. Also, the social sentiment analysis over here is also pointing to less than 30% risk on social sentiment. Most of the sentiment right now is either related to Bitcoin or ETH, and also the size of the bearish narrative is slightly higher than that of the bullish narratives. You can check it out on the peak value indicator as well, that the bull market has come to a conclusion now that the risk levels are in this blue territory, that is less than zero point 0.2 or less than 20%, like they were back in 2022 bear market after the 2021 rally. This time around again, we did not go as high below beyond the zero point 0.6 risk level. In December 2024 we came really close to that. Now the risk levels, the composite risk level for the entire asset class are at around 14%. Typically when they are below 10%, like they were back in November 2022 or even in June July 2022, less than zero point 0.1, that's where the depths of the bear market crash or any major downturn kind of manifests. We are still several levels away from that, but again, definitely entered in this lowest risk regimen. If you want to filter it out, you can see when the asset class spends some considerable amount of time in that level. This is calculated by, again, this similar risk factors such as volatility, alpha, risk adjusted return, percent drawdown for the top 10 cryptos, but also not just the top 10 cryptos, but also several cryptos outside of top 10 which have a considerable market cap. And this one single metric quantifies what's the historical risk, and the current risk based on historical price action as well. Again, apart from 2022 and uh, most of 2023, larger part of 2024 and 2025 were outside of this uh, lowest risk regimen. Again, handful number of days in 2025 price action was below zero point 0.2 risk when there were sharp drawdowns in April of 2025. Now that in 2026, what I envision is most of the 2026, at least the first half and the second and the third quarter of 2026 price actions to stay for the entire asset class lower than the zero point 0.2 risk. Let's see what is in store for Sol with respect to. First, we'll start with something different that we have released, is the portfolio builder. This is identifying the, you could call like the gem zone or the gems of the crypto asset class. This is calculated by the annualized reward since 2021, that is annualized return or reward for an asset, and the annualized volatility or risk of an asset. Sol is in this second quadrant where the returns are high, the annualized returns is 47%, but the volatility is also high at around 99%. The Sortino ratio, which is favorable for positive volatility, is at around zero point 0.8. For context, Bitcoin's average return since 2021 was 21%, volatility was 53%, Sortino ratio was less at around 0.59. But it's one of the in the gem zone because of its lower volatility compared to Sol. What is the danger zone over here is where the average returns are less and volatility is high. Sol is not in that territory. So that means in terms of the risk profile for assets such as Sol, the composite risk score ranking just based on these metrics, uh, not the regression or time weighted average score based metrics, you could find Sol somewhere over here at 0.44 composite risk score ranking. That means it's even less risky compared to ETH when compared with price and volatility related metrics such as alpha, beta, Sortino ratio, max drawdown, and volatility. Sol is at around 0.44 risk, whereas ETH is at around zero point 0.5 risk. Bitcoin is at around 0.38 risk or slightly under zero point 0.4 risk. So the lower the score, the higher the asset has returns and lower drawdown and has a stable volatility. Higher the score, poorer the return. So with this, we did come up with a gem hunter portfolio for the top 10 cryptos of the asset class, of the crypto asset class. Bitcoin garnering about 43% share, ETH 15%, BNB about 11%, Sol at around 7%. If you are only focused on altcoins, again, not financial advice, what you can do is toggle off Bitcoin and look at other cryptos and then recalculate the percentage of a altcoin related crypto portfolio. If you have another, if you consider ETH also as a blue chip and not an altcoin, then again toggling off ETH gets you the new revised portfolio mix. If you want to only focus on 3 to 4 cryptos and just top 3 4 cryptos, then the asset mix also can be changed based on that filtering. So all of these charts are available on the website. Now coming to the Sol technical analysis, now that the price of Sol has fallen from the highs at around from the highs of 2025 to now 77% drawdown from that level. For context, in 2020, after the 2021 rally in 2022, the price fell 97% in that bear market. If let's say from cycle to cycle, instead of 97% Sol were to fall, the cycle to cycle drawdown at around, let's say, instead of 97%, the drawdown is at around 87% this time around, then the price of Sol could bottom at around somewhere close to $35. If we are slightly more hopeful, at around 85% drawdown, price could bottom at around $41 $42 for this cycle. If we go by the range where Sol spent some of the times before the catastrophic drop in 2022, the range of that drop in early part of 2022, without that FTX collapse related drop, one could argue Sol held these levels of support when Bitcoin fell below 20k at that level. That support for Sol is between $30 and $47. If we take the initial part of the drop, we did come at around 65%. Again, that was the initial drop that Sol had in 2022. The price action is now below that level of the yellow line over here. The next level for Sol to drop is at around 44% away from the current price of about $80. That's at around the top of the channel is at around $47. If it goes to the middle part of the channel, the drop could be at around $37. That would be akin to the drop to the tune of about 87% instead of 97% in 2022. So that level could be still achievable in 2026. Uh, in terms of the 200-week simple moving average over here, this blue line which has turned white, that means price is below the 200-week simple moving average for Sol. In terms of the technical levels and the Fibonacci levels, the price action from the 2021 high to the 2022 low, one could argue the 2024-2025 highs were also at the same level, ignoring the candle wicks, just the candle bodies. One could argue that essentially came at around similar level at the high, at the weekly high. So ignoring or adjusting for that levels, let's keep it as is. The price action did in the correction of early February 2026 did come and hit that 0.236 level on the Fibonacci level at around $68. Now per this model again, if the price were to go back to the 21-week exponential moving average in the coming weeks or months, there could be a rally to the 0.382 at around $100 and or $105 level before getting rejected again. The price action likes to do that in the bear market, go back to the 20-week simple moving average or 21-week exponential moving average, get rejected from there, and then go down even further in the bear market years. So now coming back to our own website and analyzing the model that we presented at the start of the video, the composite risk score, the components of that model, starting with the time weighted average price. The price action of Sol is now below the blue line, which is the time weighted average price line. This is the time spent at some of the key level, and that time spent at those key levels influences the average price in order to identify what is the cool off zone for that asset. So whenever the price action is in this shape or color where the risk levels are in, let's say, risk level 1, that means price action is either lower than the time weighted average price or has come significantly close to the time weighted average price. That lowers the time weighted average price risk, as there is a if the underlying asset has a chance to recover in the recovery years or go higher in the bull market years. Accumulating below the time weighted average price is not, historically speaking, is not the worst idea. Again, not financial advice. And even if we go by that logic, in the last bull or last bear market, the time weighted average price drop started from $57, and from there the price action went to lows of $10 or slightly lower than $10 level. So even from that level, it was 80% drop from that time weighted average price, the start of the time weighted average price lows. So just this model again tries to tune out the noise, not predict the actual bottom, but a range of accumulation zone below which, again, if you have a longer time horizon, accumulating below the time weighted average price eventually works out. At least historically speaking has worked out for higher market cap assets such as Sol, ETH, or Bitcoin. So this is the time weighted average price risk. You can see the lower risk levels typically for Sol are again manifested in the bear market years, like they did back in 2022, or even in the early launch in 2020 lows when price action was below the time weighted average price. So this individual model again was one of the significant factor that the Sol's composite risk is low. The DCA or the regression model, will start with that. Again, price action is below the regression based fair value. This pink line over here tries to identify a non-linear fair value estimation of the asset, trying to ignore the euphoria phases or the panic phases to identify what is the fair value of an asset where the price can hold its own if there is no significant fear in the market or significant greed in the market. So if we go by the analysis and assume that in the bear market the price action not just goes below the fair value but also applying the one standard deviation residual below the fair value, this lower one band, that's usually the case where the bear market bottom comes into play more so than the fair value band over here. The lower band one is the one standard deviation residual applied to the fair value. This is currently coming in at around $44, but it has slightly negative or slightly downward bias. So in the later part of 2026, this green line could well be close to that $42 level, which is again gets the price action bottoming somewhere close to that 85 to 87% down from the previous all-time high. So these distinct models are having that confluence at around $40 level. Even that technical analysis model over here, three models are pointing to that midpoint at around $38 as a kickstart of accumulation phase for Sol. So the 20-week simple moving average price risk model, the other component again, has flashed that low risk signal where the price action is in now less than 0.1 risk, or in the first again even if you look at the 2022 drop, the first two drops that Sol has had in 2022, the risk levels were in this zone. But again, as the price action started dropping, the 20-week simple moving average started catching up to the price action like it did. So, for example, the difference between the price action and the 20-week simple moving average, one could argue, was either highest in March of 2022 or in June of 2022. Then this red line, which is the 20-week simple moving average, kind of got caught up to it. And then even though there was a drop in later half of November 2022, the distance between the price and the 20-week simple moving average was not as high as it was back in June 2022. That got reflected over here in this analysis as well. The lowest risk regimen for the 20-week simple moving average was in the initial part of the bear markets. We could argue that this 2026 bear market has already manifested that late into November 2025, and then the second time in February 2026, because the peak for the asset came the last time around came in November of 2021, whereas this time came in September of 2025, or one could argue even in January of 2025, depending on how you measure the all-time high for Sol for this cycle. Again, you could see that there was a distinct higher high for Sol in January 2025 than what happened in later on in the year. So if we go by that token, the Sol bear market is much further along right now in 2026 than how it was in 2022, where it barely started at this point in March and February 2022 drop, whereas we are so much further along, as evidenced by this 20-week simple moving average drops below the 20-week simple moving average to the lower risk territory happened in the post-halving year of 2025 itself, and then the second time towards the end of 2025 itself, and now it's the third iteration over here. So this model also contributed to the lowering the risk for Sol related composite risk related accumulation model over here. So three models are pointing to a lows already being near, but just the regression model for Sol, as mentioned previously, has not gone to the one standard deviation residual. The machine learning based price analysis, again, this does not inform the composite risk score, but it's just a standalone model. This is price action of Sol at a weekly average price. This price action is fed to the seasonal ARIMA and box cost transformation based machine learning model, and also other machine learning models are behind the screen. This is in-house trained machine learning models. The non-panic bear market bottom for Sol this time around, if there is a 6 months of downturn from, again, timeline to be decided, but let's say starting mid-February to mid-July would be 6 months. 6 months of downturn for Sol takes the price action somewhere close to $40 to $35 to $40 level. If we get only 4 months of downturn, let's say, timeline again is very sensitive over here. In that case, the bottom is somewhere between $42 and $45. Again, coming back to that analysis over here, the top part of the channel between the $37 and $47, that could be the bottom for this estimation. If there is a counter trend rally in between, let's say late February, early March, then the ceiling gets slightly deflected to, let's say, closer to that $105 level before the drop starts. So that could also influence how the drop could shape. And if there is some panic, let's say the 2 standard deviation drop, if one of this 4 to 5 months have instead of a non-panic bottom, if there is one more panic bottom of a month or two, then still the price action could find support at around lower $30 range. So 2 months negative price actions, the price action can still bottom at around $30 level, depending on how we get to that point. All in all, if we were to estimate a bear market bottom, again, as a standalone estimation of what a bear market bottom for Sol is, between $39 and $49. That's what these three models are suggesting: the regression model, the time weighted average price risk, and the SMA model. This is because the price action, although below the time weighted average price right now, still the last time around in the bear market of 2022, the difference between the time weighted average price and the price at the bottom was almost 80%. So that again informs the time weighted average price risk. Again, none of the content financial advice. This is the bear market analysis and accumulation analysis for Sol. We'll like to conclude with on a bullish note or a hopeful note. Let's say if there is a price action or growth surge in 2027, 2028, these models again would not come in handy, but we would like to just present it. Again, these are right now hyper bullish case where the price of Sol to surge 30x of the current price would be quite outlandish, considering the market cap is already at around 50 billion. If it were to go to another 30x, the market cap would have to go to $1.5 trillion for Sol. And it's not impossible, but it requires a very prolonged alt season, formation of new narratives, hyper adoption, and also it's kind of unrealistic at this point in time. Just providing that ceiling before we conclude, and if not the $2,000 level, the 3 standard deviation bull case ceiling for 2028 2029 bull market is at around $500 level. This is estimated by the 3 standard deviation machine learning based price scenario. This seems more realistic than the other scenarios, considering Sol did have a new all-time high from the 2021 cycle to now that 2025 cycle. Hoping that 2028 2029 proves to be a slightly better bull market for altcoins such as Sol. And with that, I would like to conclude by saying the range that comes most to the mind is this area between $47 and $30. We could go slightly below it if there is a prolonged recession, but the accumulation phase for Sol, for most of the models, again at less than 0.3 risk, not the worst time to DCA, but again not financial advice and not close enough to the bottom at this point. With that, hope you enjoyed the content. If you did, please give a like and subscribe, and hope to see you again tomorrow. Thank you and have a nice day.